we're going to see rates go up immediately on Wednesday. But I think there's a lid on how high they can go in this range. I'm going to call it the Elon line, the 420 line. Bill Bodner likes to call it the Snoop line. Snoop Doggy Dog.
Expanding our money supply because the Fed has been restrictive. I'm going to explain that.
Credit card loans, car loans, those are short-term borrowing rates, and they are low right now.
Microsoft and Google came out and said, we're not going to reduce our billions of dollars of spending. Existing home sales, 4 million home sales annual rate. That's with a little drop.
Hey, it's KP coming to you live from Huntington Beach. There's 4 conferences going on, the MISMO Summit. I'm on their board. There's Mortgage Collaborative. There's Digital Mortgage. I mean, I'm helping them. But I'm here, just so you guys want to know where I'm at. I'm in Huntington Beach. This is our retail channel's yearly leadership conference. You guys know I don't plug a lot of, oh yeah, it's backwards, of course. I don't know. There we go. There we go. A photo flip. There's one of our great title sponsors. Look at that. Zactus, credible partner on the credit side. If you're not working with them, you need to. A bunch of great, incredible, sponsors. And I could go through the whole list, but just go check our website. Okay, here you go. Little look. It's almost sunside. Sorry. It's my boy. I used to work with him at First Magnus. Here we go. Okay, go ahead. Yeah. Yay. So we're Huntington. There's the pier. It is almost sunset. Here's our coat. What's up, boys? Cheers. Robert Holiday, our founder, co-founder, COO, Laura, Ryan. We are here. All right. You've probably never seen Robert, but he is an absolute beast. He's one of our 2 founders and gets in the weeds. Had a panel today talking about a lot of stuff. Anyway, okay, enough of that. It's Fed week. Everyone's talking about it. Should I lock? Are rates going to go up? Are they going to go up again like they did last year? Oh my gosh, I need to lock now because they're going to go up because the meeting's in 2 days. As Lee Corso said, not so fast. So there's a big difference between this year and last year. So last year, the jobs reports were actually strong. And there was a 50 basis point cut, which was kind of seen like, okay, maybe a little too much at first. Inflation was still high, definitely a lot higher than it is right now. And so all those forces combined, especially with the October first Friday of 24 jobs report, which were strong. I think it's like 247,000 jobs, something like that, which now we know half of it is gone. Well, that's not true, but we haven't seen that QCEW exact report. But on average, we know that about half the jobs of every jobs report was inaccurate. So anyway, rates went up because of strong labor, and we don't have strong labor right now. So not only do we have the QCEW data that came in, the 911,000 jobs, which I highlighted last week, obviously clearly showing that labor is not as strong as it was a year ago. But even the actual, I guess, fake Friday reports, is that what we're going to call them now? Fake Friday jobs reports? But the actual ones are weak, which means when the actual numbers come in, they may actually be weaker. So, and inflation is, generally okay. We're under 2% or under 3%. So is a different market this year. That doesn't mean we won't have what's called a buy on the rumor, sell on the news event. Really what the Fed says in the Q&A, and of course the dot plot, the summary of economic projections, which they only put out every 12 weeks, every other meeting. They meet every 6 weeks. So there's definitely some data that could sway markets. I mean, they may say, okay, inflation sign, labor's soft, but we think the economy is strong. So we're going to do this. We're going to extend out the cuts all the way through the end of 26. They may say they're doing less cuts overall on the dot plot, or they may shorten the time frame, or they may lengthen it, or they may raise it. I don't know. So there's a lot of different ways this could go. Past is not prologue here. So I couldn't tell you that we're going to see rates go up immediately on Wednesday, but I think there's a lid on how high they can go in this range. I'm going to call it the Elon line, the 420 line. Bill Bodner likes to call it the Snoop line, Snoop Doggy Dog. So yeah, I think 420 might be our new range unless we get on the fake Friday 1st October jobs report, a strong jobs report. So the trend is labor is weakening and rates have done nothing but get better for 4 months, but especially since July 3rd. So we'll see that trend. Look, if you see a loan you like or a rate you like, lock it in. So, go ahead and take care of business. Speaking of, the activity, obviously it's not purchase season. So there's a lot of refinance activity out there, and there should be. As one of our collaborators down below, Mark Hansen, does a great job talking about HEA, HEI, all the equity products. He sent me some data last week. There's I think $1.18 trillion in credit card debt with an average interest rate of 22.73%, just under 23%. That's way higher than a mortgage rate. So debt consolidation is a big deal. I think there's a ton of auto loans out there. Actually, I apologize. It was 1.2 trillion in auto loans and 1.68 trillion in credit card debt. And the auto loans are at a 7% rate. So you could do a lot of debt consolidation, equity lending, HELOCs, all that kind of stuff. So, it's not spring purchase season. But what would be interesting is obviously lower rates is a tailwind. And if we have softening labor or it doesn't strengthen from here and we keep rates at this low range, we could get this double tailwind going into the new year where you have continuous refinance activity and then you also have spring purchase season tailwind. It's obviously not spring purchase season, but it will be. And so will rates hang out long enough for us to get that double tailwind? I don't know. We don't know, but we shall see. Retail sales number comes out tomorrow. The economy is, 70% consumer spending. The estimates are for retail sales spending to go up 0.3% month over month. We'll see if that plays out. The AI trade, essentially, we have a lot of talk about AI over here and some of the platforms we're using. And there's sunset, and everyone's now departing for dinner. So we are at just about 7:00 here in Huntington Beach. And so we got some scragglers there eating some hors d'oeuvres and cocktails, my people. But we're all going to go head off to dinner and break bread together in different places. Some people went to the Dodgers-Phillies game. So AI. Okay, I have something very interesting I'm going to share with our team, but I'll share with LinkedIn. Apple, and I'm an Android user, but Apple has not picked a winner yet as an AI partner. The Google case, which ruled basically in favor of Google, actually puts Gemini as a potential partner to be the AI partner inside Apple. Or they may build their own platform natively. They could buy Perplexity. They could partner with OpenAI. And, there are 2.5 billion Apple iOS, that's the operating system, devices around the world. I think it's 1.25 billion iPhones alone. Maybe it's 1.5, but the number overall for all, everything, pads and wearables and wrists and the watch and iPhones, 2.5 billion devices around the world. They're not in a hurry to pick an AI partner because they own the installed user base. And lenders were a lot like that, okay? So we have, millions of contacts, hundreds of thousands of past clients. So when we pick an AI winner as a lender, these AI companies, they need us too. And so it's okay if your lender has not chosen a path yet to make sure they choose the right one. I've been demoing a ton of them out there and there's some great stuff. And so I think a lot of us want to pick the right one, but AI is a big deal. And by the way, I am not a financial advisor. I am not responsible for your losses, only your profits. If you think the AI trade is dead, remember there's $7 trillion in money sitting on the sidelines. And that's a lot of money. Half that's, with individual investors, half institutional money. Oracle is a massive company. They announced bang out earnings and a $300 billion deal with OpenAI, ChatGPT owner. And their massive stock went up 35%, immediately. So that's a lot of money that rushed in because it said a couple things. Big companies can still make big moves. The AI trade is not dead. And software, which, they're a big software company, is not going to get left in the dust because of AI. They'll actually work together. Software is kind of like the last domino to drop in this whole AI trade. We've got large language models, we've got physical AI, and so there's a lot still going on. We're very early in the AI trade. So I'll just leave it at that. Have a wonderful evening. I will be out with you guys on Thursday night again, under 10 minutes. Last look. There's Huntington Pier and sunset. It is gorgeous. Have a great one. Cheers. Hey, it's KP coming to you live from Corona Del Mar. We're at CDM Restaurant, and this is where I get to come break bread every now and then. I don't know where the name is on this place. Anyway, we're here on PCH. Some of you may know this. We got Gulfstream, we got Ruby's, and this is CDM Restaurant, same owner as A Restaurant. Fantastic places. Okay, Fed spoke. What happened? What's going on with rates? Why did rates go up? Everyone's asking about it. Holy shit. Are they going to go back down? So buy on the rumors, sell on the news is something that I like to say. I am not a financial advisor. I am not responsible for your losses, only your profits. But this happens at times when things kind of get overblown and everyone is saying the same thing and all the conventional wisdom says the same trade and everyone knows that they're going to cut and everyone positions because they know there's going to be a 25 basis point cut. And then the cut happens. That's the news. So they bought on the rumor and sold on the news. Okay. But it's not as simple as that, but it kind of is. So the Q&A from the Fed was very interesting. The thing that I thought was, you guys have seen, it's a divided Fed. The independence of the Fed obviously is being questioned, because Mirren was in there. He said the only dissenting vote because he wanted 50 basis points and not just 25 basis points. And so there is a divided Fed. Obviously, the Lisa Cook thing is still in the news and still going around. But the trend is your friend, right? The dot plot, the Summer of Economic Projections, they do it every other meeting, every 12 weeks, not every 6 weeks. And the dots, sometimes they're meaningless, but it is a guidepost in the moment. They're concerned about labor. They're concerned about labor because when your income goes to zero, there's nothing more deflationary. It's not good for the economy. And did you notice on their dot plot, although they went up since the June dot plot, they went to like 1.6% GDP for the year instead of 1.4%. Remember when anything less than 2% was contractionary, possibly even recession? I think their dot plot, like for the next 2 years, was all under 2. That's not a lot of growth. So if you have the unemployment rate going up to 4.5% by the end of this year, which by the way is in like 3.5 months, that's not good. So I think the trend will continue to be our friend, and they'll continue to cut rates. And if they cut rates even further, that it's more downward pressure on mortgage interest rates. But here's the caveat. Here's the thing to look for. I just had a conversation with a gentleman at a restaurant. He was a server, and he's a really good guy. And I said, look, if you don't have to know anything about anything, the first fake Friday jobs report, okay, the first Friday of October, if that is a weak labor report, rates will get better. Between then and now, yes, we have some inflation reports, but the Fed has said that it is labor over inflation. All right, I thought it was interesting when the 911,000 jobs that got wiped off the map after the QCEW, the quarterly census of employment and wages, which doesn't impact the unemployment rate for various reasons. I still think it should, but it doesn't, apparently. Chair Powell said, oh, yeah, we expected that. Yeah, that was highly anticipated. Oh, okay. So they just thought that 911,000 jobs would be wiped off the data, and it was anticipated. And so then they, was pressed on the questions about the collecting of the data. And he doubled down on the survey. It's like, we just need to get better responses, and we can work that out. Like no, buddy. Surveys are stupid. Like getting surveys is a dumb way to collect data. It's got to be a better way. Like in this age of AI and Bitcoin and drones delivering goods and little robots and my car that drives itself, like he was doubling down on survey data as the collection process. But I digress. It'll get worked out. Not in my lifetime, I guess. So I thought that was interesting. He did bring up the birth-death model, but he didn't talk about it very much. which means that really is the culprit. We all know the birth-death model has nothing to do with demographics. It's part of the establishment survey on the first fake Friday, jobs report of the month. And births means businesses opening, and deaths means businesses closing. And so they kind of model that. They kind of make it up. And, maybe the modeling is wrong. Maybe the survey modeling is wrong. Maybe the process, every industry I've ever seen gets taken over by disruptive thinking, and they don't change their thinking. I'm not saying they should not be conservative or not be slow, but they can be modern in the way they collect data and the way they do modeling and still be, cautious in how they act. Anyway, more Fed rate cuts coming, in my opinion. I think there'll be at least one more this year. But everyone was asking, well, last year when they cut 50 basis points, rates went up after that. They went up because there was a strong labor report that came after that, and several actually. So if there is a strong labor report, the first Friday of October, we could see not only this little range that we've been in, the Elon line, the 420 line, which I think right now is probably the ceiling. I think you could go higher than that if labor is strong the first Friday of October. And if it's weak, I think we can get under 4% on a 10-year treasury yield. And that would be obviously rate friendly. Did you guys see that Nvidia invested $5 billion into Intel, which just got $8 billion, obviously, from the Trump administration working out the deal as a follow-up to the CHIPS Act from the Biden administration. So that's pretty interesting to see that Nvidia took in an investment in a rival local chip making. So I guess they're buying America, and I thought that was a very interesting play. There's a lot going on in the stock market, quad witching, quarterly rebalancing of balance sheets, the Fed's moving money. The economy is still doing okay and labor is okay, but I could go on and on about all this stuff, but that's probably the most important stuff when we talk about the Fed. Weekly jobless claims, leading indicator of like the economy, was actually, not as bad as last month, like 30,000 less jobless claims, still about 1.9 million continuing claims. Still very hard to find a job, especially if you're right out of college or you're young. So we'll keep an eye on labor. It's the most important thing. Rates are still in a good spot. Cowboys won, Longhorns won. So hopefully my teams can continue. If we got any fans of football, throw it up. Throw your teams up. Start bragging or start crying like I usually do. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.